Jonathan Garner joins in now to talk about where he sees the markets headed. Jonathan, morning. Thanks for joining in. It's been quite dramatic for equity markets. Sharp fall, sharp rebound. How do you read the situation now?
We are looking for further gains in Asia ex-Japan equities in the course of 2010. We're targeting an approximate 20% return. And we think the year will be quite similar to 2004. There'll be headwinds out there that could cause a bumpy ride. Higher interest rates and a rising oil price. But there is an underlying economic recovery process, very evident in this part of the world, and corporate earnings should grow next year. So we suspect overall we'll make further progress.
The big talking point, or the only talking point, Jonathan, has been the dollar carry trade. Is that still alive and kicking and likely to extend for a while?
Yeah, I think there is a carry trade element in some parts of the emerging asset classes, most notably in foreign exchange and certain currency. But I think if you look at the underlying picture, at least as it affects equities, there's a very real economic recovery process that's going on here. And corporate earnings almost certainly troughed in October, the end of the earnings recession, and that's a good place to be for equities. So I wouldn't want to overplay this carry trade story, at least as it affects equities.
Is it a crowded trade anyway, Jonathan? Are too many people in it? Or do you think people are fundamentally inclined to these markets and it's not so much of the dollar trade which is going on?
Well, obviously, as a one-factor model, the trade-weighted dollar it is inversely correlated with the performance of emerging Asian equities. And after all, we saw last year what happened when the dollar moved up 10 big figures. That was part of the whole sort of de-risking phase, almost the panic phase of the global financial crisis. Now, we at our firm are actually looking for further dollar weakness. We're not anticipating a major bout of dollar strength. We're expecting the US, very unusually, to be one of the last countries to begin a rate hike cycle. Asia will actually begin the hike cycle first. So we're not really putting our finger here on factors that would cause the dollar to bounce. We think that de-risking of global portfolios that happened over a 3-month period last year was a temporary bout of dollar strength, and the general trend in terms of relative economic performance or the headwinds that the US faces in terms of recovery favors continued dollar weakness.
Let's talk about India. Where do you stand at Morgan Stanley on India within the emerging market basket?
Okay, so we're overweight Indian equities as we have been since around the election time in the early summer. However, we've reined back in the overweight somewhat recently. We actually took some money from our India overweight to put more into China. And that's partly thinking about relative valuations and also thinking about this rate hiking process. And we expect Indian rates to start to go up in January. And India's economic performance very, very strong off the bottom, but probably underlying inflationary pressures somewhat higher than in China.
So what would that imply, Jonathan, in terms of a range the Indian market could hold?
Well, as I said, we over the whole of calendar year 2010 from current levels, and we're expecting a 20% or so return. India, it still is an overweight for us. Great industrial production numbers, corporate earnings coming through, if anything, better than expected. I don't see any reason why we can't be looking at that kind of return for let's say, the Sensex over that time horizon.
Specifically on earnings, Jonathan, what was your takeaway from the first half and what do you expect to see in the second half of this financial year?
Yes, that's right, and we are getting upside surprises in key sectors. I mean, the sectors we like in the Indian market, as well as other of the more emerging countries that I cover, are financials. We like the real estate, consumer discretionary areas, or cyclical areas generally. And upstream energy. I mean, those are the areas that we'd want to be involved in. And we're more cautious about defensives and the telecoms area and let's say downstream energy plays.
From a tactical perspective, Jonathan, just for the next few months, do you see the likelihood or possibility of a sharp correction? And if yes, how deep could such a retracement be in your eyes?
Well, certainly if you use the analogue with 2004, you got a correction, in fact, around the time when Fed language changed. And certainly you could see that with these hikes I talked about in India, probably Korea, Brazil and Taiwan as well, all in the first quarter, you could get a correction. It's unusual to get one. during this period, November, December. They're seasonally the reallocation period. A key point we've been pointing out to clients is that whilst there have been huge inflows to global dedicated EM equity funds, truly global managers who can invest in both emerging and developed markets are actually underweight, believe it or not, the region. They never bought the market back in late 08, having sold it in late 07, and I do think that's supportive to markets. So, yeah, probably a correction at some point, probably more first half than second half. The reason you get corrections around the change in rates is that essentially people question whether policy is erring on tightening too much too soon. Then as the recovery continues to come through, markets tend to make further progress, and that's the sort of pattern we expect next year.
Even if that correction were to happen, through that and after that, do you expect the general trend of emerging market outperformance to continue?
We called a year ago for the secular trend of emerging markets outperforming developed to be resumed, and that is exactly what we've got. We regained all the performance relative losses of 08 and then gained more, so we set new performance relative highs. Asia had a far better performance through the economic recession than the developed world. It's got less headwinds to recovery, particularly through the financial system strengths. And valuations are perfectly reasonable. There's no premium in valuations for this region at the moment to the developed economies, so developed markets. So I actually suspect that the trend to outperform is sustained. The degree is probably not going to be as large as this year, when obviously we've shot the lights out. But I think we can sustain, let's say, at least 5 to 10% outperformance versus developed equities next year.
The rally up until now, though, Jonathan, has been completely globally correlated, and the big start of it has been what's happened in the US markets. What about the Dow and the S&P? What do you see there for those markets?
Well, that's not really within my purview, but what I would say is our global market strategists who looked at global developed markets would get very cautious if the S&P got above the 1200 level. At that level, it would be essentially trading on about 14 times 2-year forward consensus earnings, and they have question marks over those consensus earnings. So 1200 or so would be a problematic level for them. Whereas I just told you that 20% plus return is what we're going for in emerging Asia.
So what would you raise as a red flag or the big risk to the rally that we've seen so far?
Well, I dealt with one of them already, which is the rate cycle normalization. The other big risk is the oil price, an overshoot of the oil price. And we have to bear in mind, if our analysis is correct, that the oil market will tighten up quite quickly over the next 2 or 3 years. There is obviously a situation of excess supply right now, but the supply constraints that exist short to medium term are very significant, and therefore we have an above consensus view of how the oil price will pan out. And I think that is another additional headwind and risk to the markets, depending on how quickly that comes through.
There have been murmurs of it, Jonathan, so let me check with you as well. What are the chances, you would say, of a new high for India within the first half of 2010?
Well, I don't want to be getting, overly bullish here, but I mean, for the broad overall indices in emerging markets and Asia Pacific, we would probably be looking at 2011 or 2012 before we do that, and I suspect that's more the case as well within the Indian market rather than a 2010 phenomenon.
Jonathan Garner, appreciate your thoughts and time this morning. Thanks very much for joining in. That's the view from Morgan Stanley, still bullish on India, and emerging markets, they say, might continue to outperform. Let's take a break.